Yeah, of course, it is difficult to do any forecasting on oil prices because of the data we have. If you look at what kind of data we have, data most of the time comes with a time delay, so it is almost sometimes impossible to work with the correct data. A lot of researchers have done some forecasting analysis based on future prices or survey of analysts or some simple regression. If you look at the results with those forecasts, the results are basically inferior to random walk model, especially in the longer term. With the exception of, I believe, expected inflation, because expected inflation, we have a lot of inflation component, so there is some success in the longer term forecasting of oil prices with expected inflation, but still almost sometimes the confidence band is so large that there is no reliable forecast. But there are recent developments in forecasting of oil prices in terms of using VAR-based analysis. This model uses real activity and inventory levels or real price of oil and everything. They have some quite successful model, especially in the up to 1 year, maybe longer periods. Longer periods generally in terms of directional accuracy rather than point estimates. In my opinion, it is a difficult task to make good forecasts, and it's sometimes impossible to forecast longer term prices, and still these activities are valuable. And another issue with this forecast is that I believe it is essential to put some kind of feedback effect, financial effect from financial markets. Although a lot of research, including mine, showed that financial traders' activity do not lead to any increase or decline in prices, but it is essential to look at how this traders' activity changes expected fundamentals. So this model, including oil market-specific factors like demand, supply, inventories, or reserves or storage cost, including these essential fundamentals, then this model should incorporate also how financial traders' activity affect commercial traders' expectation regarding future fundamentals. Basically, of course, especially if you look at 2002 and onwards, demand factors has been the major driver of oil price and oil market. The growth in what you call BRICS, Brazil, Russia, India, China, contributed a lot of demand growth, and we expect this still be the true. And of course, GDP growth and demographic growth is an important factor on this one, as well as the availability of fossil fuels. But one of the most important elements in the oil market happening is the fact that consumption in OECD countries has been declining. That is accelerated with the what you call shale gas revolution. Basically, what happened instead of using oil, they start using started or is going to start using gas in some truck fleets or something, because this transportation fuel or use of oil as in the transportation has been one of the main demand side. So consumption decline in OECD countries might be what you call new way to restrict demand. Not a new way to, but is a phenomenon over there. We have to consider what you call developments in oil markets. And the second thing, of course, is the what we see now in North American oil boom. This is going to be for us or for policymakers are going to be a game changer. These are very important developments in terms of energy security and also political consequences. And in terms of course, what will this development lead in the first place in terms of changing the trade direction? What we have seen, U.S. start what you call importing less from Africa, and then they start using their own light crude oil, and then Canada is exporting much more than before. So now basically North America import dependency will be much lower than previously expected. So this will have, of course, a price impact. I thought that this issue has already been resolved, but still there are still discussion, of course. In my own opinion, and my research showed that speculation, whatever you call, or trading, financial trader activity in futures market do not lead to any price change, as opposed, I mean, Granger causality or other research methods show that the causation runs from the what you call prices to trader position rather than position to what you call price change. The main link between the future prices and the spot prices is through the inventories. Let's say that let's define speculation as buying or selling of any assets, including oil, as a response to expectation of price change. In this broader sense, broader definition, we can say that motorists, let's say a driver, who expect some kind of supply shortages in the future, will go and fill up his car with gas. Then what is he doing basically? In an anticipation of price increase, now he's just taking precaution. So he's increasing the demand for oil today. Basically, price of oil will increase. Some oil will be drawn from what's called market now when the oil is abundant. Then, basically, if he is correct in his prediction, in the future, price is going to be basically, due to supply shortages, price might be higher. But since he got already his gas, then there is going to be lesser demand in the future. So basically his speculation smooth out the price impact. Current price increase, future price decline. Therefore, speculation in this fashion lowers the volatility while having no effect on the long-term prices. Similarly, if we look at speculation by financial traders, of course, these financial traders do not take delivery of any physical oil. But what do they do? Let's say that they expect in the future prices to rise. What do they get? How do they get this information? Information coming from the physical market. Let's say they expect future prices to rise. Then they start buying futures contract, and then future price rise. And of course, a producer, consider a producer or some commercial trader can see this one, and then of course they can immediately take some oil out of the markets because price is going to increase. They can sell it with a higher price in the future. So what's going to happen now? Spot prices is going to increase, but future prices is going to, in the later period, is going to increase less than initially predicted, because now some of oil today, which was supposed to be consumed today, is going to be available for future delivery. So speculation is going to smooth the price transition from current to future period. Therefore, this speculative activity also reduces the volatility while having almost no effect on long-term prices, while future prices going down and then spot prices going up, and on the average, but long-term it's not going to be affected by financial trader or speculator activity in futures markets.